Hi guys, Jacklyn Saunders with Dominion Lending Centers here again for another video. Another long-winded video. Basically, this is about certain questions that I get asked as a mortgage broker. They're the most common questions, so I thought I'd throw it on a video and hopefully answer some of your questions. So, first question is, do I need to have at least 5% for a down payment? Although a down payment of at least 5% is mandatory, there are still ways to get the funding for it. So one advantage of being a first-time homebuyer is you can use up to $25,000 of your RRSPs per borrower to use for your down payment. You'll have to pay back 1/15 per year. And depending on your circumstance, you may be able to borrow your down payment from a personal line of credit, or gifted funds may be available to you as well. A cashback mortgage is another option. So how it works is you receive a cash advance once your loan has been confirmed. There are some cashback products that can offer 5% of the mortgage amount as cash back, or sometimes even more. So the money that you receive from this product may be used for your down payment, but you are subject to higher interest rates for a cashback mortgage. Second question, won't my bank give me the best rate? Not so much. So banks actually profit from their customers' loyalty because loyal customers shop around the least. I hear this all the time. Um, and I used to think this too, that my bank would just offer me the best rate that they have because I feel that they would be obligated to because I've been a client for so long. But most lending institutions generally offer their posted rates, which are significantly higher interest rates. So a huge perk to using a mortgage broker is that we are given discounted rates because of the amount of business that we bring to the lenders. Third question, if I have to pay a penalty to get out of my mortgage, then I should just wait until my mortgage term is up, right? Penalty costs can be large, but it may be worth it in the long term, and this is why. Basically, all you have to do is ask your broker to do some calculations. Calculate the difference between your penalty to break your current mortgage and then the costs associated with breaking that mortgage and registering a new mortgage versus the savings and interest over the term of the mortgage. So some lenders actually cover a portion of the penalty if you switch your business over to them. They might even cover all of it depending on the amount. So all you have to do, you just ask your broker and say, look, this is my situation. Will it actually save me money to break my mortgage? Fourth question, do I have to pay to use a mortgage broker? So a mortgage broker, we don't charge the client, so our services don't come at cost to you for anything. So even your calls and your emails and us answering your questions, you're not going to get a bill in the mail. We're not a lawyer. We don't charge you for any of that. If you decide to use our services, then whichever lender that we decide will best suit your needs, that lender will then pay us a referral fee for referring your business over to them. And it doesn't come out of your mortgage. It doesn't affect you at all. So that's something that you should know. In complicated situations, though, a broker will charge a small fee. Like if you were denied, so due to bad credit or other issues, which would in turn force the mortgage broker to look into private lending instead of a bank or a credit union. So in those cases, when you were denied, would be denied from banks and credit unions. Well, then that would in turn make your mortgage broker seek an alternative method, which is a private lender, which private lenders charge fees, so in turn we would have to charge them as well. But your mortgage broker would disclose that up front, so you would know that right away. Fifth question, is the maximum amortization period 30 years? No, if you have a down payment of at least 20%, then you'll still qualify for an amortization of 35 and sometimes even 40 years. So the benefit is if you have the money to put in the required down payment, the longer amortization lessens your payments. So not only does it lessen your payment, if you put 20% down, you also avoid those insurance premiums from CMHC and Genworth that you might have heard of, which can save you quite a bit of money. Sixth question, I'll never qualify for a mortgage with poor credit, right? There are many lenders out there that do specialize in finding funding for those that do have bad credit. So you'll likely have to put in a higher down payment and pay higher interest rates due to the risk, but it still may be possible. Every circumstance and situation is different. So on a side note, one thing to remember is just because you have been pre-approved for a mortgage doesn't mean that your financing is set in stone. A broker will require documentation verifying your income and some other paperwork up front. And another thing is if the mortgage is insured, and I might have mentioned this before, the insurer has the final say on whether your funding will be approved or not. So the insurer orders an appraisal on the property that you put an offer in on or you're wishing to purchase. And from that, like I said, they'll make that final approval. So thank you very much for watching. If you have any questions, please don't hesitate to give me a call, 604-916-4727, or send me an email at jacklyn@dominionlending.ca. Thank you for watching. I hope it was helpful.